What is export factoring? Let's understand with an example. Let's say there is a company called A Limited. It is selling goods worth $1 million to a company in USA, let's say B Incorp, right? So this $1 million sales is happening at a credit terms of, let's say, 60 days. So it means A Limited will get this money from B Incorporation only after 60 days. But in this time period, they have to manage their show. They need funds. So what A Limited will do, A Limited will approach a factor, let's say a factor like SBI factor, and it will sell this invoice of $1 million. And what SBI factor will do? SBI factor will take the responsibility of collecting this money from B Incorporation. So they take responsibility for collection, number one. Number two, SBI factor will also be ready to lend to A Limited on the strength of this invoice. Okay, let's say this is $1 million and bank is ready to lend up to $0.8 million. So this is going to release the cash for A Limited because they got almost 80% of the invoice value now, and their working capital is taken care. And SBI factor will follow up with the B Incorporation on the due date, and they will get that entire 1 million. And when they do so, they will deduct their charges. So there can be interest for the loan, there can be a one-time payment fee. So after deducting these two, whatever is the balance, that will be remitted by the factors to A Limited, and this is how export factoring works.